Hi there, and welcome to The Street here on BNN Bloomberg. I'm Paul Bagnall. Thank you for joining us this morning. On today's show, we'll get an early look at second quarter earnings season. Pressures are starting to creep into companies' income statements. Our featured guest of the morning will also talk about the comeback of income stocks, and she'll name 3 Canadian dividend payers she's bought for clients. Finally, we'll speak with a trade expert on just where Canada stands now in its difficult negotiations with the U.S. on tariffs. And we want to hear from you this morning. In our first call segment near the end of this show, we'll invite you to ask questions of our featured guest of the morning, Brianne Gardner of Velocity Investment Partners, Raymond James. So get ready with your questions on North American large cap stocks. We'll have Brianne answer as many of your questions as she can. The number to reach us at will be 1-855-326-6266. We'll open the phones in about 30 minutes from now, and our email address is firstcall@bellmedia.ca. You can send us a question right now. Let's get started with the stories that we're watching for you here in the BNN Bloomberg newsroom. McDonald's Canada has named Anne-Marie Savink as the next president and chief executive officer. Savink comes to McDonald's Canada after serving as managing director of McDonald's Netherlands. She replaces outgoing chief executive officer Michelle Boudria, who's retiring after 40 years with the company. The changes take effect on September the 1st. Global miner Rio Tinto says U.S. tariffs on Canadian-made aluminum created pre-tax costs of more than $300 million in the first half of the year. Rio Tinto is the world's second largest miner and Canada's largest aluminum producer. While most of Rio's sales go to the U.S., the company says a substantial part of the costs have been clawed back from tariffs on U.S. aluminum. There's a look at our first look at markets so far this morning. You can see the Dow Jones Industrial Average up by about 1/5 of a percentage point. The NASDAQ 100 down by a similar degree. Yesterday, the only strength we saw in U.S. markets was in the NASDAQ Composite Index, and the S&P 500 futures contract flat at this moment. And now our top story. Second quarter earnings season began yesterday for big U.S. corporations. A trio of big Wall Street banks kicked it off. And with tariff and economic uncertainty front and center, it's been called the most important earnings season for investors in several years. Our featured guest of the morning, of course, has been watching the results closely. She's got lots to say on what she's seen so far. Let's welcome Brianne Gardner to the program. She's portfolio manager at Velocity Investment Partners, Raymond James. Brianne, great to have you on the show this morning. Thanks for making time for us. What trends have you seen so far in earnings season? What did you make of the comments made by big bank executives yesterday in the U.S.?
Yeah, thanks for having me as always, Paul. I think on that earnings front, results have been, a little mixed. I think we saw big banks really beat the headline numbers, but some of their guidance struck more of a cautious tone. I think looking overall, though, we did see, credit quality at JP Morgan, Chase, Citigroup, and Wells Fargo held up remarkably well. I think that's showing us that consumers have been resilient, right, and continue to spend regardless of tariffs or inflation, and still while paying off their debts. And the bank said that in their earnings report. So for us, yes, there are still some signs of potential cost pressures are starting to creep in, and we will see if these tariffs do start to flow into earnings. And I think expectations are being a little bit reset, not dramatically, but still noticeably. So I think, as you mentioned, with these big banks, kicking off things, the tone on some of the what we will see will be interesting, because that will pivot us to how we will be positioning, I think, a little bit more for the second half of the year. If we're looking on, net interest income, or we're even assessing loan growth with more caution, I think this is to remind investors that tailwinds from higher rates may be fading. We looked at BlackRock too, beat on earnings. which again, highlighting how quickly large institutions flows can shift and reminding us that investors still caution is running deeply and even in strong markets. For me, one thing that I think might be happening, especially where valuations are, which, I think we'll talk about later, is that some of these stocks, not technically the financial sector, but other sectors that are a little bit overvaluated right now, if we see any miss or on earnings or outlook, I think we will see a little bit of pullback in some of these names and reset those valuations. So you could see some stocks have a little bit more extreme volatility as we are coming into Q2 earnings.
In the first quarter, trade tariff uncertainty was clearly the theme, and we're starting to see it again in this quarter. You, in some notes prepared for this conversation, you flagged ASML earnings as an important set of earnings results due today. Those numbers are out now, and ASML has walked back its sales forecast for the next year. I'm reading now from Bloomberg News, walking back its sales forecast for the upcoming year, blaming trade disputes and global tensions. So just as we saw a lot of optimism and bullish sentiment around the likes of NVIDIA and AMD, they got permission to sell high-end chips to China. We're seeing some negative tone here on ASML. Do you think we'll see more of this in the second quarter?
Yeah, I do think, a lot of investors and consumers, I think, thought that the trade negotiations and trade impacts would be a little bit more delayed, but I think you are starting to see them already flow through companies, and companies are making adjustments. And we have seen that from some large companies as well. I think some of the aluminum companies in Canada have impacted even the first half of the year about $300 million in their revenue. So for us, that is something that we are definitely watching closely. I think, as you mentioned, ASML, offering really a read on global chip demand, I think deal-making appetite and consumer health at a time when markets are really searching for the next catalyst right now. It seems like everything is being a little bit brushed off. So I do think this is going to be definitely a critical environment into Q2 earnings. And for us, we're really focused on companies that have that staying power, right? Strong balance sheets, I think pricing flexibility, and really exposure to long-term themes like AI, like you mentioned, Paul, like infrastructure that we are seeing going to be in spending in this big, beautiful bill, and still healthcare that has undervalued from a valuation standpoint. So we still see opportunity here, but it's not the headlines. It's more in the fundamentals. And we are going to see a flood of earnings, I think, today, tomorrow, and Friday, some big names too. Netflix reports on Thursday, 3M reports on Friday. Today, as you mentioned, Morgan Stanley, Johnson & Johnson, United. So there are going to be some big names coming out over the next few days.
Brianne Gardner on what she's seen so far and what she will be looking for as second quarter earnings reports roll out from big U.S. corporations in the weeks ahead. Up next, Brianne Gardner on the return of income stocks. Next. Welcome back. Let's take an expanded view of the market, and then Brianne Gardner will talk to us about income-paying stocks, including 3 that she's buying for clients right now. Here's a look at U.S. futures. And we see a positive tone in the Dow contract, a negative tone in the NASDAQ 100 contract. The S&P 500 flat so far this morning in the futures market. Let's go to major Asian markets and how they concluded the trading day. Tokyo fell very slightly. The declines were more substantial in Hong Kong and in Shanghai, where the CSI 300 is a benchmark index. Here's a live look at European stocks. They are up today. The FTSE 100, the CAC 40, and the German DAX index, all in positive territory. The DAX extending its remarkable rally so far this year. New pledges on defense spending. A big part of that story. The DAX index now up 21% so far in 2025. Here's a look at the S&P TSX Composite and how it performed yesterday, down by 0.5 percentage point, still maintaining a 27,000 point plus level. And here's a look at the biggest winners and losers on a pure percentage basis yesterday. Energy Fuels is a uranium stock. It rose by nearly 11%. Brookfield Renewable Partners rose by more than 6%. On the downside, Tamarack Valley, a mid-cap or a small-cap oil and gas producer, down by nearly 3%. And Richelieu Hardware down by about 3% as well. Here's a look at metals. There's gold at $3,345 per ounce. Greg Taylor was one of our featured guests earlier this week. He believes that gold prices have consolidated recently and are setting up for a rally higher. He does expect higher gold prices from here. Silver's in the news as well. There's silver at $38 and change. Analysts at Citigroup in New York have raised their targets on silver. The 6-month target is $43 per ounce. The 3-month target is $40 even per ounce. They say robust investor demand is a big part of the silver story. Silver is up more than 30%. The price of silver is since early April. Copper has also been in focus. It's been affected by a tariff pledge by Donald Trump. U.S. traded copper in New York, the September contract now trading at $5.55 U.S. per pound. Here's crude oil, down by more than a full percentage point to $65.75 U.S. Here's Western Canadian Select, the Canadian grade of heavy oil, $54.11. The differential only about $11 and change right now. One reason that differential has narrowed, it was quite often 15, 16, 17 US dollars per barrel. The Trans Mountain Pipeline expansion, which is now delivering oil to the coast of British Columbia and onto tankers and abroad. Well, let's resume our conversation with Brianne Gardner for more on the role of income stocks in your portfolio. Brianne joins us now. She's Senior Wealth Advisor at Velocity Investment Partners, Raymond James. Brianne, one thing that, of course, our viewers know is that central banks are dialing back interest rates, perhaps not as quickly as the equity market would like, perhaps not as quickly as owners of variable rate mortgages would like, but they have come down nonetheless. And this changes the calculus, of course, on the role of dividend-paying stocks and income-paying stocks in a portfolio.
Yeah, exactly. And I think, we've seen more cuts out of Canada, certainly, than the US. And that, I think we will continue to see. I think right now there is a little bit of pause or on hold, and we will revisit come September. But for right now, I think the start of the year and headed into 2025, really, income stocks were out of favor. I think we saw a lot of investors that were more focused on AI, the AI trend, growth stocks, and a lot of momentum, really anything but more yield. But with global central banks kind of shifting gears, the narrative is really changing fast, and we see that starting to evolve. I think stock valuations is something that we look at, especially for entry points, for positioning for the portfolio, and how to be overweight and underweight certain sectors. And if we look at the S&P 500 specifically, we are seeing it trading in the 94th percentile versus its 30-year average. So for us, that's a clear signal that the markets are priced for optimism right now. If I'm looking at each sector, industrials stand out as one of the most expensive sectors, both absolute and relative terms, to us, suggesting that high expectations are already priced in. And if I look at more of healthcare and even real estate, I think are showing significant discounts relative to their broader market. So from an income basis, as you mentioned, Paul, we're now seeing the early effects of some of this easing policy. I think it was noted that when the U.S. short-term rates drop by 1% only, U.S. home prices tend to rise by about 5% over the next 3 years. So that could be a strong signal really for the real estate sector and more income-focused assets. And that's what we're looking at, and that's what we're really assessing. Does that dynamic flow straight into real estate investment trusts? And I think as properties, potentially values their rise, then we'll see REITs or real estate investment trusts really benefit from some of the stronger loan to value ratios, better access to credit, and more room to fund growth.
One real estate investment trust that you've added to client portfolios is Granite Real Estate Investment Trust, Granite REIT. It acquires, develops, and builds industrial properties. Talk to us about Granite.
Yeah, I think Granite REIT, there is a little bit of a defensive angle there too. I think with some of the uncertainty around trade, tariffs, global politics, you can get income stocks like REITs and even utilities that can offer more stable returns. So Granite REIT is one of those stocks. It gives us a solid real estate exposure with still kind of strong tenants. And that's what we look for, right? Especially in the real estate sector, because not all real estate stocks are the same. I think a lot of investors see some high yielding stocks, but some of their margins might be stretched or too much debt or inconsistent cash flow. And those really won't hold up well if we start to see cracks or a slowing economy out of the US. So for us, Granite REIT, if I'm just looking at a straight value, ranks a 9 out of 10 for us, and is still a profitable company that we see more upside on. So it is a stock that we like to hold, or that we continue to hold in the real estate space.
Fortis is a well-known utility company and also a dividend payer as a utility. Why do you like Fortis?
Yeah, I think the utilities, as we talked about in the beginning of the year, were really out of favor. And I think people were kind of avoiding them overall. But we do see Fortis adding a little bit more reliability through regulated utilities, and see it again. These aren't flashy trades. These aren't the next big winner. I think these are exactly the kind of stable income producing assets that some clients want and we want at the rate as the rate cycle begins to shift. And Fortis is one of those names. So fundamentally, Fortis ranks an 8 out of 10 for us. Has been chugging sideways a little bit year to date recently, but it's still, a great company, great quality. You're getting a decent dividend yield from the stock. You're still getting about 3.75 there. And again, we see more upside and that consistent reliability from the income and cash flow there from Fortis.
That's Brianne Gardner on dividend pairs. There's one, I promised you that she would name three. We don't have time for her to talk about the third. It's Brookfield Infrastructure Partners, BIP.UN in Toronto. That's the third one that she likes. Up next, we'll be back with Brianne to talk about retirement, a new financial phase for people moving out of the workforce. She'll talk about how retirees should think about their portfolios right after this. It's time now for On the Radar, which is a closer look at what an investing professional is looking at in the markets these days. We're back with Brianne Gardner. She's with Velocity Investment Partners, Raymond James. Brianne, you wanted to talk about retirement as a new phase of financial life, and that's a pretty topical conversation in my household these days, because I think, as you know, I'm 3 days away from retiring myself. So my wife and I have been talking about this. Let's talk about how investors who are about my age or so should be thinking about the final phase of their investing life, or certainly a new phase of their investing life.
Yeah, Paul, and I thought this was a relevant discussion for you, and as you are headed into this next chapter. And I would say retirement isn't the end; it's a new financial phase. And to a lot of people, retirement is a new career. It can last 25 to 35 plus years now, so almost a full third of your life. And I do think that investing for retirement doesn't just change overnight; it's a process that is different for everyone. And I think depending on your wealth, what buckets you have money in, how to draw those buckets, where to spend from, can depend on your own situations. You're no longer collecting a paycheck, you're paying yourself. And for some people that have been paying themselves for years leading up to full retirement, that can change too. So again, retirement isn't a finish line, it's just a halfway point of your financial marathon. So get excited for that. But I think there are, real risks in retirement that we look at, and those four risks are longevity risk, outliving your money, inflation erosion, healthcare inflation and costs going up, and I think really sequence of returns risk. So poor early on derailment of your retirement. So if we're going to talk about longevity, I think Canadians are living longer. We are seeing that across the board, 83 plus years on average, many into their 90s. Our financial plans were projecting 95 to 100 now. So that's more time not only to enjoy your life in retirement and do the things you want to do, but more years to support yourself financially. And I do think, means planning longer, planning an event, and don't underestimate those extra years.
So
another one.
We often hear that that older people need to consider these days a higher exposure to equities than they might assume, because that's where the growth comes from in a portfolio. And if you do not want to outlive your money or run out of money, to put it another way, you need to think about higher equity market risk. Do you agree?
I think it depends again on cash flow needs and goals. Certainly, I think and also where interest rates are, right? So for 2022, we were super underweight interest or bonds, because we knew that when interest rates were going up, that bond yields would go down. And now vice versa, we've tilted the portfolios a little bit the other way. So I do think changes to the portfolio, again, not just straight blanket answer, is really there. And I do think a lot of retirees think they need to shift their portfolio, the other way and go extremely conservative because they are worried about running out of money. But I do think playing it too safe can also be risky. GICs and bonds generally don't keep up with inflation or longevity needs. So you actually could be losing money long-term after taxes and inflation. So as much as, too risky could be a concern, too conservative could also hurt your retirement as much as too risky. And you want to make sure that your investment plan, and you have that plan in place, that does really balance out that risk tolerance of your needs and returns. And I do think that stocks, as you mentioned, have delivered great returns over the long run, but not without volatility. That does require a strategy to have good risk management. And really that's what we're focused on, is downside protective and that active risk management, so clients can better sleep at night.
We've only got about 60 seconds left in this conversation. What about healthcare? As people age, they tend to have more healthcare needs. Many of them, if they're leaving an employer, no longer have supplemental health insurance, although there are options out there to purchase it on your own. How should retirees think about healthcare and covering their necessary healthcare costs?
Yeah, I don't think healthcare is going anywhere. And I think especially after COVID, people and investors and consumers have started prioritizing their health, right? So better healthcare also that we offer equals longer life. But as you mentioned, with higher costs. So we see seniors spending about $5,500 to $6,000 a year out of pocket, again, with rising costs. So healthcare can definitely get more expensive than ever in retirement. Travel insurance, not as much extended healthcare that can help boost those costs. But at the same time, don't let higher travel insurance or those costs prevent you from doing the things that you want to do and creating those memories and adventures. So for us, we work with some specialists who can help with insurance or help look at your options there. But I do think especially looking at brokers who can find the best solutions for you, because I do think healthcare is not going anywhere and those expenses are continuously going up, even if you're going to be looking at short-term or potentially long-term live-in or in-home care down the road too. Those add an expense into your retirement plan and budget.
Brianne Gardner on some things to think about if you are retiring. Still ahead, after the break, we'll hear more on tariffs and their effects on this country and where we stand right now in our torturous relationship with U.S. President Donald Trump on the tariff file. That's next. And our phone lines will open soon for our first call segment. Get ready to give us a call at 1-855-326-6266 or send us an email right now at firstcall@bellmedia.ca. Brianne Gardner will take your questions on North American large cap stocks. Prime Minister Mark Carney is expected to be in Hamilton, Ontario today to meet with workers and make an announcement about the steel industry. Carney's visit comes more than a month after U.S. President Donald Trump doubled tariffs on Canadian steel and aluminum from 25% to 50%. Those are shipments into the United States. Carney told reporters yesterday he does not believe Donald Trump will sign any trade deals without including some tariffs. Aluminum miner Rio Tinto says U.S. tariffs on Canadian-made aluminum created pre-tax costs for it of more than $300 million in the first half of this year. Rio Tinto is the world's second largest miner and Canada's largest aluminum producer. While most of Rio's sales go to the United States, the company says a substantial part of the costs have been clawed back from U.S. tariffs on U.S. aluminum. McDonald's Canada has named Anne-Marie Svintink as the new president and chief executive officer of the company. Svintink comes to Canada after serving as managing director of McDonald's Netherlands. She replaces outgoing chief executive officer Michelle Boudria, who is retiring after 40 years at McDonald's Canada. Those changes take effect on September the 1st. Here's a look at U.S. futures. The Dow contract is showing some meaningful upside. It's up by 1/3 of a percentage point. The decline that we saw in the NASDAQ 100 has withered away. That index is now flat in the futures market. And the S&P 500 futures contract, which was flat just 15 or so minutes ago, is now up by 16/100ths of a percentage point. So the shift in momentum has been positive as we inch closer to the open of trading at 9:30 a.m. Eastern Time. That's 58 minutes away from right now. Well, our next guest is here to talk about tariffs and their effect on this economy and the negotiations between our two countries, Canada and the United States. We're joined now by Lachlan Wolfers. He's leader of KPMG Law and joins us right now. Lachlan, thanks a lot for joining us. Let's begin with the signaling from the Prime Minister on this. Mark Carney is clearly telling Canadians to moderate their expectations on where negotiations with the U.S. are going, that a tariff-free agreement is unlikely. Where do you think this is going by the time this is finally over?
Yeah, good morning, Paul. Great to be with you. So I think if we start off from the proposition that President Trump is trying to set up the 1st of August as being Groundhog Day or Liberation Day, the sequel, I think if you look at where the U.S. administration is at the moment, I would say that emboldened by the fact that for the first 9 months of the fiscal year, the US has raised over $100 billion of revenue from tariffs, and perhaps more remarkably, in the month of June 2025, the US achieved its first monthly tax surplus since 2017. So likely emboldened. And I think your observation that Prime Minister Carney is warming the public up to the idea to expect tariffs is absolutely right. It could also signal that a deal is relatively imminent as well. If we break it down a little bit, what we've learned so far in terms of where I think Canada could ideally get to in this situation. So the UK negotiated a 10% broad-based tariff, Vietnam 20%, and overnight we learned Indonesia negotiated 19%. So it gives you a little bit of a benchmark around where that sits. But if you actually look beyond the headlines, and you've got to recognize that you've got two different ways of negotiating here. President Trump's is very much to do that in public through social media. Prime Minister Carney's has been to do this in the background and to keep the negotiations largely confidential. The UK deal is instructive. What it says is 10% baseline, which I think is probably a best case scenario for Canada. It also says, if you look at it on the very first page, it's not a legal agreement, which is interesting. And then you look throughout the terms of the 5-page document, and there's a bunch of commitments and general promises, and we shall do this and we will consider doing this. And I actually think it's very much a strategy of trying to kick a lot of the can down the road. And I think that's probably a best case scenario for Canada. These are not broad-based trade agreements. These are narrow, constructed terms, the intent of which seems to be to deliver a great news headline, but there's not a whole lot of deal or substance that sits within them.
Okay, I'm going to give the next question to Brianne Gardner. She's a portfolio manager. She's joining us from Vancouver. Brianne.
Yeah, thanks for joining us, Lachlan. I think, what a lot of investors are comparing this to is 2018, 2019 version. And I'd love to get your thoughts on really the take on this tariff playbook versus then from a market perspective. We have seen a similar trend. We saw a sell-off market, V-shaped correction market hit new highs again, and then, choppiness and a few 7 to 8 sell-offs for the rest of the years as trade settles. And I see a similar pattern happening in the market. But what is your take on really any similarities or differences from what happened in the 2018, 2019 version for now?
Yeah, it's a great question, Brianne. So I think if we step back from it, this Sunday marks 6 months in office of President Trump's second term. And I think throughout that 6 months, we've seen a degree of chaos and instability and uncertainty from a tariff perspective. The question that I would really ask from an investor perspective is, do we have any reason to believe that the next 3.5 years will be any different? That's the first question. I'm not convinced, and I know I'm not alone in this, that markets have reacted in quite the way they need to from the perspective of what is likely to occur on the 1st of August. In other words, I think they have underreacted to this because of round one of the tariffs where they were pulled relatively quickly. And even dating back, as you said, to 2018-19, the tariff measures that were in place then were for a relatively short period of time. I don't think that's the case here. And I do think we've got to be looking at this as more of a longer term play. I think the second thing that I would say, and this is really important from a Canadian perspective, is Canada was relatively on its own in the sense of retaliating against the tariff measures. And there's a great quote from a famous UK economist, Joan Robinson, which is the idea that when other countries erect tariffs, we think it's sensible to do the same. And her quote is along the lines of, it's just as sensible to drop rocks in our harbours because other nations have rocky harbours too. It doesn't make sense. So I think the message from a Canadian perspective needs to be, how do we turn from defence into offence? And offence is not necessarily retaliatory tariffs. Offence is around how businesses can take active steps to mitigate their own tariff costs and to trade around this as effectively as possible. And what I've seen is the uncertainty in markets has created an environment where people haven't been able to engage in that medium to long-term planning. My advice is they now need to do that.
Lachlan Wolfers, thank you for this conversation. Lachlan Wolfers is leader of KPMG Law. Still ahead, today's market drivers with Bloomberg's Divya Balji. We'll get more on those big three bank earnings that rolled out yesterday. And our phone lines are now open. Brianne Gardner will be ready shortly to take your questions on North American large cap stocks. So get ready to give us a call. In fact, pick up your phone and call us right now at 1-855-326-6266 or send us an email right now at firstcall@bellmedia.ca. Welcome back. Let's take a look at some pre-market movers with Bloomberg's Divya Balji. She, of course, is managing editor for Breaking News Americas. Divya, good morning, and thanks for joining us. Let's talk about bank earnings. Three big ones yesterday, about 24 hours ago, and Bank of America is out today, and I think Goldman Sachs is on deck for today as well. How should we be thinking about these bank results so far?
Yeah, I think the overarching theme here is, market volatility that has really helped all of these banks, see a massive boost in their trading revenue, whether that's equity sales or fixed income. What we're seeing in today's results in particular is equity trading has really stood out for these banks. Goldman has had a record quarter when it comes to equity trading. So that's really standing out. As we've already seen, we do know know, we've seen this market volatility with the tariffs and everything that's been happening with the White House. And that's really what's feeding these results that have come in. We've seen it across all the banks. That's one element of it. The other element is, of course, there was a little bit of concern around investment banking fees. Now, Goldman is obviously one of the leaders on that front. They actually posted very, very solid numbers. The concern was around deals actually closing and getting those fees. Obviously, we've seen a lot of deal announcements, but have they closed? Clearly, we're seeing it in the numbers. Goldman in particular with a strong beat when it comes to investment banking. So I think that really sums up banks now that we've had all 6 of them report, and all really with a huge focus on volatility and market trading. And that's what's given them a boost in the past quarter.
Let's move to the pharmaceutical sector. J&J has also reported results. I'm seeing the Bloomberg headline telling me that J&J shrugs off the Trump pharma tariff and boosts its outlook.
Yeah, I mean, I find this all quite interesting. You know, going into this earnings season, we have seen a couple of companies outside of banks already report. We had Delta last week, we have J&J this week, and obviously we're going to have a whole bunch more coming through. You know, when you see J&J, they've boosted their forecast. You know, it's sort of telling you that they are getting used to the current situation, or the current turmoil, I guess, if you can call it that, when it comes to tariffs, you know. And one thing the CFO is really pointing out too is he sort of sees this as a slow ramp up when it comes to tariffs, and that he thinks is actually good in terms of how any company can plan ahead and figure out how they can reduce costs. You know, do their tariff costs even drop because it's a slower ramp up? We have seen Trump threaten specifically, you know, very, very high tariffs when it comes to the pharma industry. They also have to deal with a drug pricing initiative that the administration is also looking at. But right now, you know, with the way things are going, this slow ramp up that the company is pointing to with current tariffs and future tariffs is possibly helping them and bringing down their costs probably, and then also giving them the opportunity to either reinstate their forecasts or boost their forecasts like we saw with J&J today.
Divya Baldry, always great to touch base with you. Thanks so much for joining us this morning. Up next, we'll bring you a notable call. We'll tell you what analysts are saying on French car maker Renault right after this. Welcome back. If you're a fan of European cars, our notable call today may have you grinding your gears. Renault, the shares of Renault, down 18% in European trading. This follows a profit warning that the company issued yesterday. Various commercial pressures, including tariffs from the United States, are causing the shares to dip, according to traders and analysts. Analyst Michael Founcoudis says Renault's decline is a stark warning. He says the stock's price target will retreat. He's going to cut that price target to 55 euros from the earlier target of 60 euros per share. When we come back, Brianne Gardner takes your questions on North American large cap stocks. Okay, time for our first call when the viewer gets an opportunity to put a question directly to an investing professional. Today, that's Brianne Gardner. And our first question, Brianne, comes from William in Oakville. It's a question via email, or is this a call, control room? I'm seeing email. Is this this is an email. Okay, let's please have your guest comment on the reason why most Canadian large banks, the exception being Bank of Nova Scotia, have suddenly become a hot commodity over the past couple of months, with stock prices in double-digit increase territory during that time frame. The question from the viewer is, Brianne, your thoughts on the bank stocks and in particular the big rally we've seen recently.
Yeah, I mean, I think we have seen Canadian banks do very well, especially over the last few months. I think growth rates are continuously being steady. Some of the other points that were just made too about loans, and the banks really set up well post kind of COVID with their loan loss provisions and having a lot of capital on the sidelines. And I think that they are still, and the amount of mortgage renewals that we've seen at a little bit of higher rates, the banks will be profiting from those. So for us, we see that, yes, there could be, some signs of small defaults here and there, but Canadians are still renewing their mortgages. Interest rates in Canada, we have seen 2% of cuts, which is consistently going to increase lending and borrowing out of Canada, which will continue to be profitable for Canadian banks. So yes, I think still bullish on Canadian banks, even amid some of this turmoil with the tariffs and everything there, that Canadian banks should continue to do well. I think looking from a valuation standpoint, though, for us, it's not a bad time to be taking some profits off the table right now. I think the run-up that we have seen has been a little bit elevated, but it doesn't mean that we're not still optimistic, at least over the medium term, for the Canadian bank stocks.
Okay, thanks for the question on Canadian bank stocks. Here comes another email. This one's on Sun Life Financial, the big life insurance company. The stock has lagged the market this year. The stock is flat year to date. The TSX Composite, of course, is up about 9%. Michael writes as follows. He would like our guest's opinion on Sun Life Financial, buy, hold, or sell.
Yeah, Sun Life Financial is actually a stock that we did pick up in our portfolio, and has kind of, as you can see from the chart there, pretty flat year to date. Has participated in the April rally though, but since then has a little bit pulled back. You're still getting a decent dividend yield from Sun Life, about 4%, and from a value score, it scores about 8 out of 10 for us, and you're still seeing that long-term upward trend over the long run. So still, Sun Life is one of the big 3 Canadian life insurance. And I think as the aging demographics and the amount of insurance going through Canada, we think that is going to continue to pick up. The Canadian businesses contributed about 38% of adjusted earnings. So in that segment alone. So for us, we still see, yes, it is a stock that we own. We're, a little bit on a upper end on the buy outperform, but we still see more upside from here out of Sun Life Financial.
Okay, let's go to the phones now. Daniel is in Markham, Ontario. Daniel, thanks for calling. What's your question to Brianne?
Hi, Paul. Hi, Brianne. Your thoughts on ASML? Is there an entry point for a buying opportunity, or am I late to the party? As usual, Brianne, one of the great guests on BNN, and Paul, great host. All the best after Friday.
Thank you very much. Brianne, ASML.
Yeah, ASML, again, not a stock that I do own in the portfolio, but one that we certainly do watch. I think, U.S. tariff turmoil certainly has put some pressure on this stock. And I think, definitely rattling a little bit of investors there. For us, I think the supplier of kind of the chip maker equipment does definitely hit on an upbeat note. And we don't think that AI is going anywhere, but it's still a big driver of growth for both the logic and memory chips. And I think customers are investing in more capacity for more advanced products there. So for us, from an entry point perspective, I would be a little bit patient. I mean, year to date, I think that we're seeing the stock down a little bit from that perspective, and a little bit at higher end of the PE, not at the highest end from some of these tech chip names. There you go, year to date, up 18% there. But for us, I would wait for a little bit of a pullback in that. It is a clear uptrend, though. If I would wait to see, if you could see a 5-6% sell-off from here, I would say looking at kind of that 780 range or 800 range is what I would be looking for from an entry point.
Okay, Amin is in Ottawa. He's one of our regular callers. Amin, great to hear from you again. What's your question for Brianne Gardner?
Paul, we are very sad to hear that you are retiring, but I am totally with Brian. You never retired, and you have a best career. You know everything about stocks, so you should proceed your career.
Okay.
My question about Brian is, Yesterday I was on market call and I followed the guest's advice. Now I'm looking for a stock to invest. I sold everything.
Okay, I think he's looking. Are you looking for a U.S. bank stock? Is that what you're looking for, or a stock generally to buy right now? Okay, let's go. Let's leave it there. I mean, he has sold some stocks. He asked a guest yesterday about a stock to buy. Let's talk about one in the financial services sector and then another in any other sector, if you've got one.
Sure. One in the financial sector, I think I would say that we continuously hold JP Morgan for sure, and we still see upside there. Fundamentally ranks an 8 out of 10 for us, has had a little bit of a pullback, so not a bad entry point too for a long-term investor, and is still one of the largest, and I mean, I think most reputable financial institutions out of the US, nearly $4 trillion in assets alone, and they continue to be a leader in that space, and in that large cap value financial banking. And for us, we still see some upside on the stock. Again, if you are waiting for a little bit more, but for us, outperformance on a consensus rating there for JP Morgan.
Okay. And that's the end of our call-in segment. Thank you to everybody who took time to present a question to Brianne Gardner. Brianne, I know you and I are going to bump into each other before too long again, but this is the last time that we will talk in this way. And I just want to say that you have been a great featured guest on the street and a guest on Market Call as well. And I want to thank you for all your contributions that you've made. It's been great having conversations with you to serve the interests of our viewers, Brianne.
Yeah, Paul, it's been honestly an absolute pleasure working with you over the years. I think, thank you for always your thoughtful questions, your professionalism, and for always making really your guests feel welcome. It truly has been enjoyable being a guest expert on the show, and I'll certainly miss all of our conversations, and I wish you all the best in this next chapter. You'll definitely be greatly missed on BNN Bloomberg.
Okay, Brianne Gardner, thank you so much. And that wraps up this edition of The Street. The Open with John Ehrlichman is up right after this.